Hello, my fellow investors, and welcome back to another earnings report video. And I guess I should premise a few things before we actually get started. If you hear any noise outside or any extra noise, there's kids playing outside right now, so yeah, sorry about that. And the second thing is that apparently I was told to wear a better shirt. So yeah, here's a better shirt, apparently. The video that you guys are going to see later today at 4 p.m., which is my wife's dividend journey, I'm going to have the badge shirt on because, yeah, I kind of recorded that before I was told to wear a better shirt, which, by the way, it was her who told me that. So, yeah, I'm going to take her advice. And, yeah, guys, let's actually get on with these earnings. So we're going to take a look at the company Enbridge, which just had earnings on Friday. And well, we were going to cover this one on the live stream. Obviously, we didn't have the live stream, but I figured, you know what? There's been a commenter here that's been commenting, and he's a really cool guy. Like, I'm not gonna, be mad or anything. But Chad, he's been telling us you guys need to do a lot more Canadian companies. So I'm like, okay, that's a fair point because we should do a lot more Canadian, at least Americas, right? Mexico, U.S. and Canadian companies. Mainly because, it's right here. It's right at home, right? It's also not too hard either to do. So I figured, you know what? Let's actually take a look at the company Enbridge. They are a Canadian company. They're in the energy sector, which I like. And yeah, let's just see what they got. This is the second time I've ever looked at this company. So this will be fairly interesting. So with that said, let's get started with this video. So now let's jump into their earnings summary. Here we got Enbridge non-GAAP EPS of 68 cents, Canadian cents, reaffirms fiscal year 2023 outlook. Now, the calculator, all the numbers that are in the calculator, they're taken from Seeking Alpha, they are automatically changed over to USD. So that's not an issue right there. So just keep that in mind that while this is showing Canadian dollars / cents, the numbers that we're going to use in the discounted free cash flow are already in USD. All right, so just keep that in mind. The reaffirming fiscal year 2023 outlook, so that's, I guess, decent enough. Again, I don't really know about this company too much. I've only ever looked at this company one time. But if they're in the energy sector, I would like to see how 2020 impacted them. Now, while I know that they are in the energy sector, I would like to take a look at what they actually do a little bit here. So we got Enbridge, together with its subsidiaries, operates as an energy infrastructure company. The company operates through 5 segments: liquid pipelines, gas transmissions and midstreams, gas distribution and storage, renewable power generation, and energy services. So they mainly do gas. Okay, so interesting. They're going to be a little bit not secluded, but I guess protected from the whole crude oil crash that happened in 2020. So actually does explain those numbers a lot now that I think about it. So, all right, there you go. Mainly a gas company, right? So, all right, let's take a look at now their actual earnings release. So here we got Enbridge reports strong second quarter 2023 financial results and reaffirms financial outlook. Let's take a look at these bullet points. We got second quarter GAAP earnings of $1.8 billion. Is this in US? I don't know if this is in US dollars or if this is in Canadian dollars. So I'm going to think it's Canadian. So I'm going to say $1.8 billion Canadian dollars, 91 cents per common share compared to the GAAP earnings of $0.5 billion. Or wow, that is a massive jump, guys. Massive jump. Look at that. From $500 million in 2022 to almost $2 billion in 2023. That's very good. Adjusted earnings of $1.4 billion, 68 cents per common share compared to the $1.4 billion. So that's not actually, that's pretty much the same as opposed to 2022. So, okay. Adjusted earnings before interest, EBITDA. So, adjusted EBITDA of $4 billion, an increase of 8% compared to the $3.7 billion in 2022. Cash provided by operating activities of $3.4 billion compared to $2.5 billion in 2022. Distributable cash flow of $2.8 billion, an increase of 1% compared to the $2.7 billion in 2022. So, okay, that's a little bit of an increase right there. Reaffirmed 2023 full year guidance for EBITDA and, wow, distributed free cash flow and medium-term outlook. That's good to see as well. Planning construction of the first phase in Rio Bravo pipeline, which will transport 2.6. I don't know what that is when it comes to natural gas. BCF per day? All right, natural gas feedstocks to supply Rio Grande LNG. I know LNG is liquid natural gas, so that's fine. Extended and upsized the Flanagan South Pipeline, blinding open season for U.S. Gulf Coast delivery service. Right? Issued $0.4 billion aggregate amount of sustainability-linked bonds in Canada, further strengthening Enbridge commitment to its emissions reduction goals. Issued the 22nd sustainability report demonstrating the company's ongoing progress towards goals set in November 2020, on track to achieve debt to EBITDA in the lower half of the target range by year end, providing financial flexibility and demonstrating commitment to our equity self-funding model. So all of that sounds really, really good. Now the CEO always says so much. I'm only going to read just the first paragraph on this. We got, continuing our strong start of the year, Enbridge's 4 businesses delivered another solid quarter of financial performance. Our first choice customer service offering and operating reliability continued to result in high utilization across our systems. We continue to execute on our strategic priorities and are on track to achieve our full year EBITDA and DCF per share guidance. All of that sounds really great. Of course, the link to this will be in the description below if you guys would like to read it. It's a very, very lengthy earnings report. So yeah, you guys are going to have to take a look at that for yourselves, which by the way, I always encourage people to read the earnings report, the 10Ks for themselves. Again, this is not financial advice or due diligence. So with that said, let's jump now into the calculator. We got the ticker for ENB. Market cap of $72.7 billion. Again, this is all in USD. PE of 40.69. So that's already looking pretty high compared to some companies, though. That's actually not that high at all. Current share price of $35.94. Now, looking at this graph on the 1 year, this is down 17%. Year to date, this is also down 8%. So that's interesting because we are at pretty near 52-week lows of $35.02, 52-week high of $44.58. Now I'm very curious as to what the peak was. The peak was the peak was on June 7th, 2022, as of recently, right? June 7th, 2022, $47.53, and even at COVID, it wasn't even that high either. It wasn't even at all-time highs, right? All-time highs was rather recently. So yeah, this company has gone nowhere. This company has gone nowhere in the past 5 years. So interesting. This is actually really, really interesting. I'm curious. What about the max? Whoa, what happened here? So definitely something happened right here in 2011. Wow, that looks pretty massive, but again, I don't necessarily know what. Regardless though, you can see the company pretty much hasn't gone anywhere since around like the 2010s kind of mark. Now they do pay out a dividend of $2.63, which it is a yield of 7.32%. Wow, that's crazy. A payout ratio of 61.5, a 5-year CAGR of 5.45, 0 consecutive years of dividend payment. Now I'm very concerned about that, right? Very concerned about that. And okay, this is actually a little bit interesting because you can see here that look at that. They've had a few instances here where they bring it down slightly, but then they bring it back up. Yeah, so this is interesting because I believe as of 2021, they have not increased it at all. I mean, the highest point was that at 69 cents, and then I don't think they brought it back up ever since. So they're kind of remaining around like the 66 cents. I would actually argue 65 cents to around 69 cents. So that's interesting right there. All right. I don't know. I would normally be like, they're consistent, but they're not because they have been cutting it, but it's only been a few cents. So that's a little bit weary right there. Ex-dividend date passed as of May 12th. Payout date was on June 1st. And of course, they do pay their dividends quarterly. Coming back over here, based off of this $2.63 and their current shares outstanding, they pay out $5.3 billion in dividends every single year. In regards to their free cash flow, guys, this is negative $2.3 billion as of their 5-year average and negative $463 million in their last year's free cash flow. They cannot afford this thing in the slightest. I would not be surprised if this dividend gets completely cut, honestly, because that's very, very concerning. So let's jump now into the fundamentals. We got 5 years ago of $2.1 billion to 1 year ago of $2.22 billion, increase of 5%. Now this graph is very, very choppy. I would have given it a bigger grade if the 1 year ago value was a lot closer or even surpassing that of the 3 year ago value, around $2.6 billion. So the reason why I would actually give that is because I'm like, well, it's choppy, but there's at least a pattern, right? So this is not a pattern. I'm going to have to say, I would say at around like an 85%, I would think. Looking now into the free cash flow. Oh, wait a minute. This is actually not as bad as I thought. I actually thought this was going to be so much worse. Okay, we got 5 years ago of 2.71 billion to 1 year ago of 4.86 billion. That is an increase of 80% with an average of $3.03 billion. Now, okay, I'm looking at this graph and I'm just like, it doesn't look bad. They still can't afford that dividend though. So on the graph perspective, it's looking great. Dividend perspective, not so much. Now this graph looks absolutely crazy. I actually really like it. 2 years ago, only outlier where they dropped going from 3.4 billion down to 1.14 billion. It's an outlier, right? It's an outlier. Can this not be an outlier? Yes, right? Yes. However, we just read the earnings report and they just said that they are pretty much increasing their DCF, right? So I am actually going to not give them a bad grade, honestly. I'm going to assume that's an outlier. I'm going to ding them though, but I'm going to assume it's an outlier. So I'm going to say it around like an 80%. I would say 80%, right? Not 880. We got 80% over here. All right. I think that's pretty fair. Again, I just do not trust that dividend when it comes to this free cash flow, but the graph itself looks really, really good. Looking now into the revenue. Revenue doesn't even look that bad either. 5 years ago of almost 34 billion to 1 year ago of 39.4 billion, increase of 15.88. We can see here that COVID did affect them. But here's the thing. COVID did affect them 3 and 2 years ago. You can see that they did climb back up to where 4 years ago was. Though 2 years ago it wasn't necessarily a full I guess recovery. But they did do that as of 1 year ago. So I'm going to give them the benefit of the doubt. I'm going to say 3 and 2 years ago were outliers. Can happen again, but I'm going to give them the benefit of the doubt. I'm going to say it around like a 90%. Not 90%. Looking now into the assets minus the liabilities. This one isn't looking too hot. You can see here consistently decreasing, though as of today they are slightly ticking up, but that's not necessarily a pattern. The pattern is pretty consistently decreasing, even prior to that of COVID. So yeah, there really is no excuse there. Average total assets, it is 129.8 billion. Average liabilities is almost 80 billion. Doing the difference, we get almost $50 billion in the positive. I would say, the graph is still decreasing. So I'm going to say at around like a 55% or so. Looking now into the cash flow minus the liabilities, pretty consistently decreasing, as you can see right here. Though as of 1 year ago, they did bring it back up a little bit. And again, I think that they are going to continue to do this, but the trend is to come down. In fact, as of 1 year ago, they're at almost negative 81 billion. And their average, it is negative 74 billion. So unfortunately, I'm going to have to give this thing, I would say like a 20%. No, I'm going to say like a 10%. Because I don't know how this is going to look like this year. So it is what it is. Looking now into the shares outstanding. Now, okay, this does not look good, right? It is increasing at a pretty consistent rate. However, that rate is very small. We got 5 years ago of 2.02 billion shares to today of, actually, I guess I should say, we got 2.022 billion shares to today of 2.025 billion shares. Guys, that is an increase of only 0.15%. And my mistake, I was wrong about this. They're not consistently increasing. There was a slight dip. I mean a 0.05% dip when it comes to their shares outstanding. 2 years ago of 2.026 billion shares to 2.025 billion shares as of 1 year ago. So it's, yeah, here's the thing with this. It's not a lot. I'm not worried about this at all. I'm going to say give them like an 80%. Because even though it is increasing, it's not a lot. It's pretty consistent. I know what I'm getting. So I'm looking at this. I'm like, I don't think it's that bad, honestly. It really isn't. And lastly, cash and coins they currently hold $777 million with an average of $479 million. All right. Overall grades. Take a look at this. Net income 85, free cash flow 80, revenue 90, assets minus liabilities 55, cash flow minus liabilities 10, shares outstanding of 80, overall grade of 74. This is interesting because the majority of these stuff here that we're seeing, at least the issues, it's looking like it's like outliers, right? It's looking like it's outliers to, well, in the form of the free cash flow, it was 2 years ago where it was the massive outlier, but on average is usually the 3 and the 2 outliers. So outlier does not make a recovery doesn't necessarily mean that it'll continue, right? So just keep that in mind. 74 though, it's looking all right. I would like to see how this year ends first though. And of course, looking at the current share price, not inputting anything, we get $21.16. Adjusting for debt though, this goes into the negative, $7.70. Now, this is in the negatives because they have a lot more debt than they do cash on hand. But let's see if we input anything here, will that change, right? So let's go with the projected share buyback, right? They've been very consistent, right? Very consistent overall, on average, 0.15% in the past 5 years. So I'm going to say, on average, that they're going to do that same exact 0.15% in the next 5 years. So let's do that, right? So let's go with what was it? 0.15%. Okay, for some reason, okay, fair enough. 0.15 is that going to do it? Okay, there it is. It's not 0.2. This is just rounding error, but there you go. All right. For the projected, this is negative. My bad. This is also in the negative. So let's do that. Now, for the lowest assumption, let's say I guess let's say a full 1%, right? Let's say a full, yeah, let's just say a full 1%. And then for the highest assumption, let's just say 0, right? So we got -1, -0.15, and then 0, saying that they're not going to do anything. All right, now for the revenue. Well, if we come over here to Seeking Alpha, we can see that the revenue is a -0.79. I'm not gonna do that. I'm not. I guess we can do that, but I would prefer giving them the 1, 2, and 3 treatment, right? The 1, 2, and 3% treatment. It's the bare minimum. I don't think that they'll do anything less than that, honestly. So with this, we get the target share prices of $21.71 to $23.54. Again, current share price is $36. This is a company that I honestly, me personally, I would wait until the end of this year and see what happens. But if you want to buy it right now, this is looking great. Now, obviously, adjusting for debt, this goes into negatives because they have a lot more debt than do cash on hand. But again, that's not really much of an issue. I personally, I would just wait. I would wait till the end of the year. If you guys would like to buy it, based off of my numbers, then I wouldn't necessarily. It's a fair price right now, I guess. A $10, a little bit more than $10 premium. Again, this really is up to you. Now, if you guys disagree with my assumptions, have these calculators for free and make your own assumptions, right? Again, all investment is the present value of all future cash flow, and this is not due diligence. So these calculators are available for free for that reason. So please use them. And all we ask for in return, guys, is just like, subscribe, comment. It really does help her with the algorithm on YouTube. We're planning to keep live streaming this upcoming week. A little bit less though, but we are planning to live stream, especially on CPI Day. That's on Thursday. That's gonna be massive. So that'll be fun. And yeah, guys, that is the best way that you guys can help us if you so wish to help us. If you like this type of content, then like, subscribe, comment. It really does help here on YouTube as well as Rumble. Now, with that massive yield, this is an insane dividend, right? Putting in $5,725, we get almost $420. It got so close. $420, guys, in annual dividends. But then again, these payout ratios do not look good, and we just saw that history. The history is not reliable either. To be fair, from 69 to 65, it really isn't much, but I just don't necessarily like it. I like either growing or consistency, right? If it's consistent, like for example, like City, that one doesn't cut the dividend, it just keeps it the same. At least you're being consistent with it. So this one's a little bit wonky, a little bit inconsistent, but not too much inconsistent. It's a little bit weird. So still though, that's a massive, massive yield. And now looking at the options chain. Sorry that it just got so dark. Guys, these option chains do not look too good. This company trades really bad when it comes to option chains. And this is for the expiration of August 18th. Looking at September 15th, which by the way, those are it, right? Those are just like, it goes bi-monthly. It really doesn't, there really isn't any liquidity here. These ones for September 15th, it still isn't looking good. So Definitely not a company that you that you want to sell options, either puts or calls, to make any sort of premium income, because there really isn't any. All in all, really exciting to do this company. Sorry we couldn't cover it in the live stream, but it is what it is, covering it now. So hopefully, Chad, this helps when it comes to if you would like to invest in this company, and anybody else who was thinking about it. So yeah, guys, again, y'all can follow us on the new sites. Link is in the description below if you guys would like to help us. Just like, subscribe, comment, of course, share. And with that said, peace out, and we'll see you all next time.